Hey everyone, and welcome. Today, we're going to give your trading analysis a serious upgrade. We're moving beyond the basics and diving deep into advanced moving averages. These are the tools designed to give you a more responsive, up-to-the-minute view of what the market is really up to right now.
So let me ask you something. Does it ever feel like your indicators are just one step behind? Like your charts are telling you yesterday's news? Well, that's the classic problem with simple moving averages. They lag. They're based on old data, which means by the time they signal a big move, you might have already missed the boat.
So what's the big upgrade here? Let's break it down. On the left, you've got the old school simple moving average. It's reactive because it gives every single price point the same importance, which, makes it kind of slow. But on the right, advanced moving averages are a different beast entirely. They are weighted, which means they put way more emphasis on what's happening right now, and that makes them so much more responsive.
All right, so let's pop the hood on this advanced toolkit, shall we? We're about to meet the key instruments that can bring some serious precision to your trading game.
First up, the exponential moving average, or the EMA. This one is a huge favorite among traders, and for good reason. By loading up the importance on the very latest prices, it reacts way faster to any new changes in the trend. It's pretty much perfect if you're trying to jump on those short-term moves before they take off.
Next, we have the weighted moving average, or WMA. Think of it as a cousin to the EMA. It also prioritizes recent data, but it does it in a linear, more gradual way. The magic here is that it helps smooth out some of that crazy market chatter, giving you a cleaner signal without being too slow to react.
Now, if you want something even smoother, you've got the Hull Moving Average, or HMA. This thing is like the WMA went to finishing school. Its whole design is about being incredibly smooth on the chart, while aggressively cutting down on that frustrating lag as much as humanly possible.
And for the traders out there who absolutely demand speed, there's the double exponential moving average, the DEMA. It sounds intense, right? It uses this really clever formula with two EMAs to basically put the indicator on overdrive. It's all about trying to get you that signal like yesterday.
Okay, so we've got this awesome new set of tools. That's great, but a tool is pretty useless if you don't know how to use it, right? So let's dive into the powerful strategies that turn these lines on a chart into real, actionable trading ideas. One of the most powerful and widely used strategies is the moving average crossover. It's one of the most popular strategies out there, and honestly, the concept is beautifully simple. You're just watching for a fast, short-term average to cross over a slower, long-term one. That one little cross can be a huge tell that the entire market momentum is shifting.
Let's talk about the big one. You've probably heard of it, the golden cross. This is what happens when a shorter-term average, say the 50-day EMA, punches above a longer-term one, like the 200-day EMA. When that happens, for a lot of traders, that's like a big flashing green light. It's a classic sign that a bullish run, an uptrend, could be just getting started. And of course, where there's a hero, there's a villain. On the flip side, we have its ominous counterpart, the death cross. Yeah, the name kind of says it all, doesn't it? This is the exact opposite. The 50-day EMA dives below the 200-day. It's a major bearish signal, warning that the party might be over and a downtrend is coming. But hey, it's not all about the crossovers. These advanced averages can also act like moving support and resistance lines. Think of them as a price floor or ceiling that actually travels along with the price. The smoother ones, like the WMA and HMA, are fantastic for just filtering out the noise in choppy markets. And you can even layer multiple EMAs together to create a ribbon that shows you how strong a trend really is.
Okay, theory is great, but how does this all play out in the real world, with real money on the line? Let's bring this all to life with a quick case study. We'll follow a trader, let's call him David, and see how he used these exact tools to trade the S&P 500. So David had a really clear, methodical plan. Let's walk through it. Step 1. He picked his weapons, the 20, 50, and 200-day EMAs. Then the application. He didn't just jump in. He waited for that textbook golden cross to confirm the move before he entered a long position. Next, management. This is key. He didn't just set it and forget it. He used that 50-day EMA as a sort of moving support level to add to his winning position. And finally, the exit. Just as disciplined as his entry, he closed his trade as soon as his short-term trendline, the 20-day, crossed below the 50-day. So David's trade worked out beautifully. Awesome, right? But, and this is a big but, we have to keep it real. These tools are incredibly powerful, but they are not a crystal ball. That means we have to understand both their incredible strengths
and their very real weaknesses.
So it really comes down to a trade-off, like pretty much everything in trading. On the plus side, you get way more responsiveness, you can smooth out that crazy volatility, and you can spot trends so much better. But the risks, they're very real. You have to remember, they are still lagging indicators, just less laggy. And in a market that's just chopping sideways with no clear direction, oh man, you can get whipsawed, getting false signals back and forth that just eat up your account. And there's this sneaky danger of overfitting, where you tweak your settings to perfectly match past performance, making it useless for the future.
Whew, okay. We've gone through the tools, the strategies, the real-world risks, the whole shebang. So after all of that, what's the big takeaway here? What should you walk away remembering? You know, it all boils down to this one idea. It's not about finding some magic system that's never wrong. That doesn't exist. It's about having a more refined toolkit to help you see trends more clearly, filter out all that market noise, and ultimately manage your risk a whole lot better.
And that really leads us to the final and most important question. And this one's for you. We've laid out the advanced toolkit and the playbook, but watching this is just the first step. So the question is, how are you going to take these tools and strategies and forge your own unique edge in the markets?